What's up? My name is Ken. In today's video, we're gonna go over the very important topic which should find its place in your investing journey. It's how to invest in stocks safely. We'll talk about what to look for in safe stocks, what are the benchmarks, what are the red flags to consider before investing your hard-earned money into any company, and we're gonna review some of the safe stocks that are considered by many investors. Before we get to know what are these safe stocks, just make sure to trade that like button and invest in subscription to the channel for more content. And if you are a long-term investor, so you might want to buy me a coffee, the link is down in the description. I'm quite sure that you've been thinking of the idea of investing in stocks risk-free. We all would want that, but unfortunately there is no such thing that a 100% safe stock. Even the best companies can face unexpected trouble, and it's common for even most stable corporations to experience significant stock price volatility. We've seen this in early 2020 when the COVID-19 pandemic came out, when many strong companies generally considered safe have experienced dramatic drop in its stock price. If you want a completely safe investment with essentially no chance that you'll lose some money, Treasury securities or CDs may be your best bet. That said, some stocks are significantly safer than others. If the company is in good financial shape, has pricing power over its rivals, and sells products that people buy even during deep recessions, it's likely to be a relatively safe investment. Now let's take a look at how to find these type of stocks. As I said above, no stock is perfect, okay? But you certainly gather a portfolio of a relatively safe stocks if you do some stock analysis. If safety is a priority, consider these 4 benchmarks. The first is steady growing revenue. Look for companies that grow their revenue steadily year over year. Erratic revenue tends to correlate with erratic stock prices, while consistent revenue is more common among stocks with less volatility. Second benchmark that you want to look for is lack of cyclicality. Cyclicality is a word that describes how sensitive economically the company is. The economy goes through cycles of expansion and recession, and cyclical companies perform well in expansions and less well during recessions. Let me explain an example. For example, the automobile industry is cyclical because people buy fewer automobiles during recessions. On the other hand, utilities aren't cyclical because people always need water and electricity. The third thing you want to look at is dividend growth. A good way to gauge a company's long-term stability is to take a look at its dividend history. Well, if it provides a dividend at all. If a company has rarely or never cut its dividends and has a strong history of increasing payouts even in tough economies, that's a great sign. There is a term called dividend aristocrat. A dividend aristocrat is a stock that's increased its dividends for at least 25 consecutive years. So a list of those stocks would be a good place to start with. Number 4 is durable competitive advantages. This could be the most important thing to look for. Generally, competitive advantages comes in several forms. This is a well-known brand name, a cost-advantage manufacturing process, or if there are high barriers to entry to the industry. By identifying competitive advantages, you can find companies likely to maintain or grow their market share over time. Now let's talk about red flags that could be a signal that a stock is more volatile. One of them is penny stocks. There is no precise definition of penny stocks, but generally refers to stocks that trade less than $5 per share. Well, not all these stocks that trade less than $5 are bad investments, but they are cheap for some reason, and you should check it before making any investment. Another signal about less safety is dividend cuts. If a stock has a frequent history of slashing or suspending its dividends, that could be a sign that it's not a stable business. That said, many companies have prudently suspended their dividends during the COVID-19 pandemic, but if a stock didn't have to hold its dividend payments during this time, that's a great sign of stability. The third red flag is declining or unstable revenue. Most of the companies took a revenue hit from the pandemic, but safe stocks will trend back to relative stability over the long term. If a company's revenue is up one year, then down the next, it's hard to say that it's a stable business. While consistently declining revenue is an obvious sign of unsafe stock, unstable revenue can be just as worrisome. And there is one more red flag that I want to talk about. It's about high payout ratios. If a company pays a dividend, check out the stock's earnings per share for the last 12 months and compare them to the dividend paid. If the dividend represents a high percentage of earnings, let's say like 70%, that could be said that the dividends aren't stable. As I promised in the beginning, let's review some safe stocks. With the above characteristics in mind, here are 7 stocks or funds that should deliver strong returns over time and have low volatility. One of them is Berkshire Hathaway. This is a conglomerate that owns a collection of about 60 subsidiary businesses. Many of them are non-cyclical businesses, which generally do well in any economic climate. Berkshire also owns a massive stock portfolio with large positions in Apple, Bank of America, Coca-Cola, and many more. Owning Berkshire is like owning many different investments in a single stock. Most of the components were selected by founder Warren Buffett himself, the greatest investor of all time. The next stock is the Walt Disney Company. As we've seen in 2020, Disney hasn't been immune to the COVID-19 pandemic, but in the long term, Disney's brand and valuable intellectual property, as well as its digital startups like Disney Plus, makes it a safe investment. The third on the list is Vanguard High Dividend Yield ETF. This is an exchange-traded fund that invests in a portfolio of stocks that pay above average dividends. Top holdings include JP Morgan, Johnson & Johnson, Procter & Gamble, AT&T, and there are 400 more stocks altogether. And I've pulled out Procter & Gamble into separate row in my list, and let's talk about it. This is a mainly non-cyclical business which makes products that people use in any economic environment. Procter & Gamble is a parent company behind household staples brands such as Pampers, Downy, Tide, Charmin, Gillette, and Old Spice, and these names are only few of them. Just to give you an idea of how steady and consistent of Procter & Gamble's business was over the time, consider that the company has increased its dividends over 63 consecutive years. That's one of the best dividend histories in the entire stock market. The next one is Vanguard Real Estate Index Fund. This fund invests in a diverse variety of real estate stocks and pays an above average dividend yield and could be a low risk by high potential long-term investment opportunity. In 2020, it was one of sectors hit hardest by pandemic, but the long-term investment thesis is sound and the safety of real estate is intact. Next one is about coffee. This is Starbucks. Starbucks has a big competitive advantage in its industry. It continues to increase its footprint and revenue year over year. Even during the pandemic, when it was forced to close its seating areas, consumers still flocked to Starbucks drive-through lines to pick up their favorite beverages. If you do some stock analysis, you could find more of these safe stocks, but I'm gonna finish with the Apple. Apple has the durable advantage of both loyal customer base and an ecosystem of products that designed to work best in conjunction with one another. In other words, iPhone customers tend to remain iPhone customers. It's not secret that Apple products cost more than their rivals, which only shows that Apple's got tremendous pricing power. Considering said above and finishing up this topic, here's your personal recipe for investing in safe stocks. First, one of the best ways to make your portfolio safer is to diversify. As I've said, no stock is safe from competition and volatility, so by finding relatively safe stocks and spreading your money across a bunch of them, you're giving yourself much more of a safety net than if you just purchased one or two. And second thing to consider that the stocks that I've said above and the stocks overall aren't necessarily safe over the short term. Even the best run companies experience short-term price swings. So don't worry about stock prices over days or weeks or even months, but keep your focus on companies which gonna do well over the long haul. Essentially, the recipe for safe stock investing is to find stable companies, buy a bunch of them, and hold on for the long haul. That said, hope I was useful for you guys. Drop a comment which safe stocks are you gonna include to your stock portfolio. Here are more other videos about personal finance and investments. Make sure to subscribe to the channel, like the video, and hit the notification bell. See you in the next video.